Good morning, everyone. Welcome to the Genghis Personal Investment Webinar. We'll be beginning shortly, and your host for today will be Dora Mbaye. Dora, over to you.
Hello, everyone. Welcome to the Genghis Personal Investment Webinar. We are glad you could join us. Today's session, we'll be delving into the equities market, and Caleb Mugendi, who's an investment associate at Genghis Capital, will be taking us through. Feel free to send in your questions using the Q&A tab, and we'll tackle them later during the Q&A session. So we have so much to share in so little time, so we'll just jump right in. Over to you, Caleb.
Thank you, Dora. Hi, everyone. I hope you're ready to get into today's training. We'll be looking at the equities market and how you can invest in it. So allow me to share my screen. Hope you can all see.
Yes, it's visible. Thank you.
All right. So today we'll be looking at investing in the equities market, just to understand what the equities market is, a little bit of background of how it came about and what that can do to your investments, and including equities into your portfolio, what to do, what shares you should be looking to buy, and any investment strategies that you can employ in order to capitalize on your investments in the equities market. So we're looking at an intro to equities in general as an asset class, an overview of the equities market, how to determine which stock to buy. Then we're going into equities investment strategies, the benefits of investment in equities market, and reasons for choosing a managed equity fund. So dive right into the introduction to equities. So what is equities? Basically, it represents ownership interest in a company. Basically, when you buy equities, you're buying into a company, you're buying into a business that is listed in a that is publicly listed. As an asset class, equities represents a significant proportion of many individual and institutional investment portfolios. When you look at equities as an asset class, you're looking at buying into companies that are listed, that have the potential to grow in the future, that also have the potential to give you a return in the form of dividends and price appreciation. And that's why it usually generates a lot of interest and also takes up a lot of portion in an investor's portfolio. So as we said, that equities represents an ownership interest in the company, and as a company's shareholder, you can have basically common or preferred stockholders. The more available is the common stock. It's more common. It's basically common stock that's available. The common stock represents ownership interest in a company and gives investors a claim on its operating performance. Also, it gives you an opportunity to participate in the corporate decision-making process via voting, and a claim on the company's net assets in the case of liquidation. So coming in as a common shareholder, you basically become a part owner in a business. So what are you eligible to receive? You can get dividends if the company pays dividends, and also capital appreciation on the stock's value. Then we come to preferred stock. Preferred stockholders are not as common. It's basically equity in where payments made to preference shareholders takes precedence over any payment that is made to common shareholders. That is also including during liquidation. Basically, as let's say a company does go bankrupt, you as the owner of the company get paid last, but a preference shareholder will get paid before a common shareholder. And also preferred stock usually have a predetermined dividend rate. Let's say it can be a 4% preference share or a 7% preference share. So basically that means that you should get 4% return on the par value of that share, or 7% every time there's a distribution of dividends. And that is before common stockholders get paid their dividends. So there are benefits being a preferred stockholder, being again you get your funds before common shareholders should there be liquidation in the company, and the guaranteed payment or guaranteed payment before common stockholders are paid. So in terms of the claims on a company or a business assets. In the case of liquidation, we have obviously debtors, senior debt, subordinated debt, and then we come to shareholders, that is preferred stock and common stock, that is after paying out all your liabilities to payables or anything, then you come to your equity owners, since they're owners of the company. So the most common is a common stockholder, and that's what we're going to delve more into, and that's what we're going to cover in today's training. So an overview of the equities market. The equities market is a hub, basically is a place that connects companies to will-be investors. So companies' shares are issued and traded. So you can come in the first issue or the primary issue of shares to the market is really through an initial public offering or an IPO, and this happens then on an exchange, and the exchange enables the meeting of will-be investors and the companies who are issuing the stock to come together and trade those stocks. So the market comes in the form of an exchange. It facilitates the trade between buyers, that is will-be investors, and sellers, that's either the company through the initial IPO or other stockholders who already own the stock and buy and sell in exchange. There's also the over-the-counter market where buyers and sellers find each other. There's some regulation in the over-the-counter market, some agents, for instance, but it's not as developed or as transparent as the exchange. So the equities market gives the companies access to capital to grow their businesses and investors a piece of ownership in the company. So a company that lists on the market for the first time through an IPO may be seeking to raise capital from investors in the capital markets. And they use this capital to fund their business growth and their business working capital so that they can continue to provide their services. So there are a number of exchanges across the world. We have the most known, the oldest ones. We have the London Stock Exchange, the New York Stock Exchange. We have something like the NASDAQ, Tokyo Stock Exchange. In almost all advanced economies and markets, there is a stock exchange. In Africa, we have the NSE, we have the Nigerian Stock Exchange, we have the Johannesburg Stock Exchange. So we have quite a number of stock exchanges all over the world. Coming into Kenya, we have the Nairobi Stock Exchange, where we have 57 companies that are listed from 11 different sectors. So from these sectors, we have different sectors like banking, we have insurance, we have investments, we have telecoms, we have manufacturing and allied commercial services and the like. So there are very diverse sectors, agriculture and the like, that form the companies that are listed, and there are 11 in total. And some of the notable companies, we have Safaricom from the telecommunications sector, KCB Group, Equity Group from the banking sector, and EABL from the manufacturing and allied sector. So why do companies come to list on the stock exchange, and what role does this equities market play in an economy? So the first one that we have touched on a bit is the capital raising, where companies list their stocks on an exchange as a way to obtain capital in order to grow and fund their business operation and their working capital, their growth initiatives and the like. So companies can come to the equities market in order to capital raise for their businesses. So the equity market provides a form of equity financing, where the company gives up a certain percentage of ownership to the investors in exchange for capital. So let's say you're coming in to buy Safaricom shares, for instance. If you buy 1% of the total number of issued shares, you become a 1% shareholder in Safaricom. And if it was during the IPO, you give that money to the company and they're able to fund their growth. There's also the liquidity factor. Since equity markets are centralized hub for buyers and sellers, it is easy to find someone who is willing to buy or sell the equity securities. So you're able to readily convert your securities into cash. Let's say you need cash, or you have a pressing challenge, liquidity constraint challenge, and you need cash quickly. You can easily go into the equity market and sell your shares to a new investor who will take them up and buy them from you in order to get cash. Also, let's say if you're in a private company that has just gone public, you can also sell your shares in order to free up some liquidity for you as an early investor in that company. So generally, when there's high demand and increased buying activity for stocks, the prices tend to rise. And again, when there's low demand and increased selling activity, prices tend to fall. Equities market also provides an investment option to investors, as they can customize their risk profile and get exposure to different companies, different industries, by having the option to pick different equity securities. Let's say you want to invest in the aviation industry, for instance, you can go and buy airline companies that are listed on the exchange. If you want exposure to financial services or banking, for instance, you can go and buy banks that are listed on the exchange. So it gives investors a number of investment options to channel their funds to, and to invest in different sectors, different companies across the entire globe, even globally, and also across the entire market if it's locally. So that's it for in terms of the overview. We'll go right into determining which stock, how to determine which stock to buy. And basically here we're going to look at the various reasons or the various approaches that you can use in looking at or in determining which stock to buy. So there are a number of methods that you as an investor can employ. First off, we start with the fundamental analysis. This is basically evaluating a company and trying to measure its fair or intrinsic value of the stock and of the company. So fundamental analysis is quite deep, involves studying the overall economy, the industry. We usually look at a top-down kind of analysis, where you start with the country, the industry, how is the country performing, how is the industry performing. We look at the bigger picture, and then you can narrow it down to the individual company or the individual stock. And figuring out what is the financial condition and management of the individual company. How is it in terms? How is the company performing? So here you also do a lot of analysis from all the publicly available information that is available. So that includes your earning results from the company. If it reports earnings quarterly, if it reports earnings half yearly, yearly, you go through those earnings reports. You also look at the general industry health of the economy, and see if that particular industry is poised to do well over the medium to the long term. So fundamental analysis is usually performed by analysts in the market, but also by investors who are looking to invest in a particular company. So this is a part of the due diligence that you as an investor perform before looking at buying into a company. So you're trying to get the intrinsic value, and then that's what you compare versus the current market value of a stock or a share price. So you're looking at, is there a sufficient buffer or sufficient discount between your intrinsic value or fair value that you've calculated and the current market price in the exchange. If there's a sufficient discount, then that becomes a reason to buy following the fundamental analysis. You can also look at technical analysis. This is where you look at evaluating a security based on statistics generated by market activity. You can look at past prices and volume initially. So technical analysis usually uses the use of stock charts, price charts, volume indicators. So here you need an advanced charting software that has previous prices and previous volumes to look at and to study. So the technical analysis does not attempt to measure securities' intrinsic value, but instead it uses the stock charts to identify patterns and trends that may suggest what a stock will do in the future. Basically, the technical analysis tries to go with the notion that the past replicates itself. So if a company's share price is, let's say, trending higher, you can use technical analysis to determine whether you expect it to continue trending higher. So for this, what you need is advanced charting softwares. We have various providers, providers that provide, let's say, statistics from the exchange. We have a number of providers locally in the market. We can look at MyStocks website. We also have advanced routers and Bloomberg platforms where you can get these past prices and volumes and chart and technical analysis charts, which you'll then use in determining points where you can enter and sell a security. So technical analysis, you'd have no business looking at a company's, let's say, earnings or fundamental cues, because you're more concerned about the price activity and the volume, past price activity and price volume and other past price indicators in your analysis. The third method that you can look at is relative valuation analysis. This is basically comparing the price of an asset to the market value of similar assets. So its premise is that similar assets should actually trade at similar multiples, and it uses observable variables such as price, book value, and earnings. So when you look at relative valuation, you're looking at the notion that similar assets should trade at similar prices. Now, that does not mean that if we look at the banking sector, let's say Equity Bank is trading at 40, that also KCB should trade at 40 and Cooperative Bank should trade 40. No, what you're looking at in terms of relative valuation is you're using some variables like price to earnings or price to book value to figure out the average trading multiples in a particular sector. For example, let's say it's a banking sector, you're looking at price to book value of one bank should be almost similar to the price to book value of similar banks. So here you're looking at also price to something like a ratio like price to earnings. Price to earnings ratio of one bank should be almost similar to the price to earnings ratio of the average of the banks, the listed banks that are in the same group. So one challenge in relative valuation is not as simple as it seems, but you need to be able to group the comparables so that you can have a clear picture of what exactly you're comparing with. Like, let's say you can't go and compare one bank with a manufacturing company, for instance, and again, you can't go and compare a telecommunication company with an agricultural company. So you have to compare similar companies, and the expectation is that they'll trade at similar prices. Again, relative valuation also does not look at the intrinsic valuation of either stock. It does not look at the individual pros and cons of let's say, a particular business or advantage that a particular business has over another business. So those are the three main analysis approaches that you can use as an investor when you're looking at purchasing equities or purchasing any individual stock. Most of the times, the method that we adopt in investment houses is the fundamental analysis approach, where we try to get the intrinsic valuation of a stock, and then we can either issue a buy rating, a hold rating, or a sell rating on the same. So some of the common investment mistakes that you should look out and look to avoid when investing in the equities market include buying shares in a business that you do not understand. This is one of the biggest and the most common mistake that we find investors making, because investors usually tend to gravitate towards the latest hot or fancy sounding industry while not knowing the specifics about the businesses that the underlying companies are engaged in. Basically, if something is new, it tends to create a lot of hype, it tends to create a lot of disruption in the market, and this usually attracts media coverage. And once it attracts mainstream media coverage, then a lot of investors would like to jump on, let's say, trying to jump on the latest trend, for instance. So you can go into businesses that you maybe, or industries that you, businesses that are in industries that you don't understand. Let's say we have a business like, or an industry like the electric cars, for example. You might not understand exactly what the business model is of a company that is in the electric car business, but based on the fact that it's being termed as the latest hot sounding industry, then a lot of investors would like to go and invest in that particular business without understanding the underlying fundamentals of the company. So investors should try and understand a company's business model and industry before investing. So prior to investing, try and figure out what is this company's business model, what is its competitive advantage. Can I look at this business and be certain, or have a certain degree of a certainty that in the next 2, 3, 5 years, it will be dominating this industry, and the industry will also continue to be growing. Those are the kind of questions that you need to ask yourself and be able to understand before going to buy a business a business in one of these new industries. There are a lot of new industries that are being championed, especially with the emergence of technology. As I mentioned earlier, there's the electric car business. There's also a lot of artificial intelligence that is coming about. Another industry like biotech is also coming up quite strongly. So there's a number of new industries that are being spun by technology. So before jumping into them and risking your hard and funds and cash into by buying these businesses, is more paramount for you to understand what these businesses do and the underlying business models of these companies. Another common investment mistake is following tips and investment advice from the wrong sources. Basically, there are a lot of stock promoters and let's say people who claim to have knowledge and thus can give you hot tips of which stock to buy next or which stock to buy in a week or so, maybe promising illogical returns, like in the next week or 2 weeks, the stock will be up 40%. So there's a lot of investment advice from these stock promoters and hot tips that you cannot really go with as an investor. It's more paramount that you rely either on your own analysis and research, or you try and identify and isolate sources of guidance that consistently help you to achieve profits. Let's say like a consistent fund manager or consistent a research house that has consistent research on a various topic or a various research on a various industry, for instance, that can now help you gain more knowledge about the industry and more knowledge about the various stocks that are listed and how to take advantage of that. Also, a lot of investors tend to follow the crowd, which is also detrimental because most of the times, by the time these investments or these businesses are being picked up by mainstream media, is when the investments are almost at their peak. So after they've already performed well, that's when usually they get picked up by mainstream media. And if you continue following the crowd and buying at that point, you're usually buying at a peak, and that is more likely than not to result in possible losses on your investment in the short term. Another common investment mistake is the lack of patience, being that investing is a long-term endeavor, especially investing in the stock market. So a lot of times you might get questions from will-be investors or investors who are interested in a particular stock, something like, will this stock rise by 10% in the next 1 month? Can this stock give me 20% return in the next year? Things like that are common. However, in terms of looking at it from a long-term approach, you are supposed to look at it, look at investing as a long-term endeavor, so as a long-term goal, a long-term plan, especially in the equities market, because there's a lot of volatility. Prices can swing from highs to lows quite fast based on investor sentiment. So there's a lot of times that there are a lot of swings, and if you do lack patience in your investments, you want quick returns, then more often than not, you'll end up not achieving your investment goals or achieving what you could have achieved if you had more patience. Also, letting your emotions rule. Investors should not let their emotions, especially fear and greed, control their decision. We keep hearing about the market being controlled by fear and greed. So fearful when the fear emotion is more comes up more when the market is in a bear market. By bear market, we mean that the market is declining, continuously printing lower and lower prices. And when we talk about greed, is when the market is continuously printing higher and higher prices. So those two emotions, again, we keep saying that the emotions that rule the market. There's even a fear and greed index that you can look at that tries to track the market sentiment, whether investors are fearful or whether investors are being greedy. So when you let your emotions rule your investment decisions, most of the times you end up making the wrong investment decision. Like, for example, when the market declines, your emotion is more often than not being driven by fear. So you see the market being driven by fear, so that's the emotion that is more elicit, that is more brought out from the declining prices. So usually you'll take you'll rush to sell when you can't withstand the declining prices anymore. So when your fear is at the tip. So basically, investors more often than not, they tend to sell at the wrong times, and possibly also buy at the wrong times. So you're selling when fear is at its most highest point. So when fear is at its tip, that's usually when prices are almost at their low. And then again, you tend to buy when greed is at its tip. So when prices are continuously rising and rising and rising, so you feel, let's say you bought something yesterday, it's already up 5%, you buy again. So that's greed controlling your emotion, and usually you also are buying when the investments are almost at their peak. So instead of letting your emotions rule, try and focus on the bigger picture. That do you have a long-term investment horizon? What is your investment goal for the long term? And are your actions in the short term, are they contributing to getting your long-term picture? So those are the common investment mistakes to avoid. Some other investment mistakes that are common include investors who lack knowledge about subjects, investors also who are quick to jump on any train, any new hot trend, as we talked about. So by trying to avoid these investment mistakes early in your investment endeavors, you'll be quite much ahead than the other investors. So we'll move into equities investment strategies that you can employ, looking at building on the fundamental technical analysis approaches that we talked about. So some of the investment strategies that you can employ into the equities market include the buy and hold strategy. Basically, the buy and hold strategy is a passive investment strategy where you as an investor, you buy a stock or any other security and hold them for a long period of time. This is regardless of the short-term fluctuations in the market. We know that the short-term fluctuations can be quite volatile since it's the equity market, and there are sometimes that investments are driven by sentiment. An investor then who employs a buy and hold strategy will not be concerned about these short-term gyrations in the market, the short-term highs and short-term troughs in the market, but just have a longer passive approach, long-term passive approach to investing in the stock market. Also, investors who employ the buy and hold strategy, they recognize that change takes time, and committed shareholders adopt this buy and hold strategy. So they don't treat ownership in a company as a short-term vehicle for profit, like a day trader will do, but they keep these shares through bull markets and through bear markets. So basically, they're holding, let's say, something that you can hold for decades, investment that you can hold for a decade and beyond. So these equity owners, they bear the ultimate risk of failure should the company not perform well, or the supreme reward of substantial capital appreciation should the company end up being a good investment and does quite well during the long term. So that's the first investment strategy. It's more of a passive investment strategy, the buy and hold strategy. The second investment strategy that we'll look at is the value investing strategy. So you've heard about the term value versus growth investing, and we're going to delve in more into what this is. So value investing is basically purchasing stock of companies that have significant discounts to their intrinsic value. So value investing obviously has then to employ the fundamental analysis approach, because you're looking at the current market price as compared to a stock's intrinsic value. So stocks under this category, they generally tend to have good fundamentals with the potential for capital appreciation, but may have fallen out of favor in the market and are therefore considered bargain counter. So as we said, a lot of times investments can be considered to be driven by investor sentiment toward a particular stock or a particular company or a particular sector. So when you're employing the value investing strategy, you're basically looking at stocks that have fallen out of favor in terms of the sentiment of investors. So they might have fallen out of the radar of investments and might have experienced a huge decline when you compare it as to its intrinsic value. So the key to performing value investing properly is getting companies that are bargains compared to their fair value. And the greater the discount, the higher the upside potential to be achieved once the price then reverts back and reflects its fair value. So value investing has been used by a number of renowned investors such as Warren Buffett, and one of his quotes being, "Be greedy when others are fearful, and fearful when others are greedy," encompasses the ethos of value investing. Basically, when others are being fearful, that is when stock prices are plummeting, they're making lower lows in the market, that's when you should be greedy and pick up any value company that you see and go in almost entirely. And that's what what the strategy of value investing calls for. And again, the value investing strategy is also a long-term strategy, whereby you're looking at achieving value over a long period of time. It can take months to years for these bargain counters to then reflect their fair or intrinsic value. So again, the value investing strategy has to be a long-term holding strategy. It also pulls it also borrows something from the buy and hold strategy, where you still buy an investor and hold it for an investment and hold it for the long term. So then we go into growth investing. The growth investing strategy is where you purchase stock of companies whose earnings are expected to increase at an above average rate compared to the industry sector or the overall market. So you're looking for companies that are exhibiting high growth in terms of their revenues, in terms of their earnings, and you're looking to take advantage of that as you expect the company to continue growing. So investors here, they look for investment in rapidly expanding industries where new technologies and services are being developed. So something that is, let's say, a new market, for instance, something that is, we're looking at a new market, for instance, or something that is a new industry. That's where investors typically would come in and look for growth investing companies to invest in. So one characteristic of growth investing is that the companies normally do not pay dividends, as these funds are used internally to fund a company's growth. So that can be considered as a downside, for instance, but usually the opportunity cost for paying dividends is that you do not have as much internally generated funds to continue to fund your expansion, because you're paying out those funds to shareholders as a return. So a company that's in its growth phase and is growing rapidly might need more and more capital to sustain its fast growth, because usually when you're sustaining a faster rate of growth, you're usually using capital in order to capture new markets, in order to advertise, in order to set up new processes and systems in place. So that usually takes up a lot of capital from the business, and that therefore makes it much harder for them to effectively pay out dividends to shareholders, and that's why they usually do not pay dividends. But that does not mean that the growth investment companies do not have any sort of return. Usually the return is in the form of price appreciation. So when you're employing a growth investing strategy, you basically want to try and buy share price, company's share price when it's low, and sell it when it's high, or basically selling at a higher price than when you bought it. So the idea is that the company will prosper, it will expand, it will continue to grow, and the growth in earnings and revenue will eventually translate into higher stock prices in the future. So still there's a return from investing in growth companies, because the return is achieved by higher and higher share prices. One example of this growth investing strategy is investing in companies that are, especially technology companies that are making rapid steps in innovation. They're very innovative. They're making rapid steps into new markets, for instance, that are basically a new way of reaching their customers and a new way of growing their revenues. And that has enabled growth companies to perform quite well in the stock markets, despite having the drawback of not paying dividends. The second or the third strategy that I want to talk about is the income capture strategy. So income capture strategy basically revolves around buying shares in companies that pay dividend consistently. So not all companies that are listed on the stock exchange give a dividend return. So this strategy revolves around buying into companies that actually do pay a dividend return and pay a dividend return consistently have been paying consistently over a long period of time. So a simple income capture strategy is to invest in companies that have a high dividend payout or a high dividend yield. So the dividend yield is measured by taking the dividend per share divided by the market price per share. So let's say the dividend that is being paid is 1 shilling and the share price is 20 shilling. Then that means that the dividend yield is 5%. So here investors can compare the dividend yield of any particular company to the average market's dividend yield, and then you can proceed to purchase companies that have a higher dividend yield than that of the market. So going further from the example, let's say a company is paying 1 shilling dividend and the market price per share is 20 shillings. That gives a 5% dividend yield. Let's say the market's dividend yield is 3%. Then that becomes one of the strategies, one of the counters that you can buy to capture this income, to employ this income capture strategy. Another income strategy is it revolves around purchasing companies whose dividend payout is rising over the years. It has been rising, and therefore this will translate into a higher dividend growth rate and return over a longer period of time. So this is usually when a company, let's say, has just matured. Let's say a company that was in its growth phase has been growing, but then has become a mature company, is now exhibiting lower growth rates. And during its growth trajectory, it was not paying as much dividends, but now it has started to pay dividends, and this dividend is increasing as the years go by. That's another strategy that you can employ to capture income from your equities investments through the return in the form of dividends. We then go into the momentum strategy. The momentum strategy is usually considered a technical analysis strategy where you buy stocks experiencing an uptrend and you're looking to ride that trend. So here again, this investors, they'll have to employ stock price charts, price and volume indicators to determine which stock to buy and at what point in time to buy them. So investors here, you usually want to look at a stock whose volatility has just increased and it has preferably broken out of a certain price range and has started to make higher highs, basically confirming an uptrend. And you look to time this uptrend and come into this stock, because basically you're operating on the assumption that the company will continue to perform well and the prices will continue to go higher and higher. So investors here, you'll either buy stocks at the break of a breakout, or you buy on the pullback in price, basically buying the dip, whereby still expecting a continuation of the trend and for the share price to continue moving higher and higher. So the momentum strategy is usually employed by day traders, for instance, who have the time and the softwares to look at to analyze the previous price action in a stock and time areas of potential breakouts and potential dips in price, and then expectation is that the prices will continue to go higher and higher. So one of the drawbacks in this momentum strategy is there's a lot of commissions that you need to pay to your brokerage stock brokers or your brokerage platforms, because usually when you're looking at the momentum strategy, you're trying to come in and out of a stock more times. Let's say in a period of a 1 year or 5 year period, someone who did or employed the buy and hold strategy might have invested at the same time as someone who employed the momentum strategy, but the buy and hold strategy only bought once and sold at the end of the 5 years, whereas someone who employed a momentum strategy could have bought and sold even up to 20 times within the same 5-year period. So someone who employs a momentum strategy will have to pay brokerage fees 20 times, while someone who employed the buy and hold strategy will only pay that one time buying and that one time selling. So that's one of the drawbacks in terms of the momentum strategy, because there are real life costs in carrying it out. Again, also the momentum strategy does not look at the fundamental intrinsic value or fair value of a stock. So it does not employ any hypothesis or efficient market hypothesis that stocks reflect true value, but basically they expect that winners or winning stocks will continue to rise higher and higher, and losing stocks will continue to decline in price. So those are the 5 strategies that we will cover in today's training. There are a number of other strategies like dollar cost averaging, which can be employed within these strategies. Basically, that is buying stocks at predetermined either income levels or predetermined like, let's say monthly. Let's say every month you buy stocks worth 1,000 shillings or 10,000 shillings, and you do that every month, and that way you're able to average out your share prices. Let's say you're buying into KCB, for instance. Then when you start out, you're buying at 40, 45, but then sometime in 6 months' time, maybe the stock price has come down to 35, so you're still buying and still buying. So basically, you're averaging out your cost. So you're averaging out the lows and you're averaging out the highs. So those are some of the other strategies you can employ. Also, a number of investors of late have come into the environmental and sustainable goals ESG investment framework, where you want to look at invest in companies that have a sustainable approach to doing business. So that's another investment approach, that a strategy that has gained traction of late, and a number of investors are also using that. So we'll go into the benefits of investing in the equities market. One is investment returns. As we talked about, the investment return of investing in the equities market consists of higher share prices. So that's capital appreciation, and a dividend income if the company pays dividend. So investors who have a long-term horizon, they can profit from both invested companies, from investing in companies that perform well. So you can actually get dividend income from a company and also higher share prices from the same company that you've invested in. Another benefit is the ease of access. Equities market is accessible to the entire investing public. Moreover, material information relating to particular listed companies are also readily available. So it's very easy to come in and out of the equities market, or to come into the equities market. The number of brokerages that can easily set you up, and within a few days you're already buying into the equities market. Again, another benefit is the low capital intensive investment that is required. Usually when you're purchasing shares, it's possible for people with low amounts of capital, because usually the requirement is around 100 shares of any individual company, and with share prices in the range of anything from below 1 shilling, which are called penny stocks, to 40 shillings, 50 shillings. Buying 100 of those units of those shares is not that capital intensive for most investments. So for most investors and for most investors. So the nature of it being low capital intensive in its nature is also a benefit. So a wide range of investors can come in and they can choose from a wide range of companies. If you also want to get exposure to macroeconomic trends, investing in equity markets allows you to do so. So you're able to benefit should the company's economy do well, and should a sector in particular do well, you're also able to get exposure to that and get a return from that in the form of either higher prices or higher dividend income. And finally, ownership stake in a company. As an equity investor, you're able to partner with the businesses that you have an interest in, that the businesses that you like, businesses that you frequent and you're a customer in. And through that, you're able to become a part owner and influence decisions through the decision-making process, through voting at the annual general meetings and any special or meeting that is being called by directors. So those are some of the benefits of investing in the equities market. And we'll go on to reasons for choosing a managed equity fund. Basically, the task of determining what stock to buy can be daunting, especially for new equity investors. And one alternative way of accessing the benefits of the equities market is through investing in an equity fund. So some of the reasons to invest in an equity fund include the due diligence. Basically, in order for you to undertake analysis of a number of investable companies, you need to put in a large amount of time to do the due diligence, to do the analysis. As we said, more of the strategies involve fundamental analysis of companies in sectors and in industries, and also of the company itself. And that takes a lot of time and effort in going through all the available publicly publicly available information that is available to the public. So this, for some investors, they don't mind doing the due diligence and something that they're interested in, but other investors might not have the time or the capability to do this analysis and this due diligence. So a fund manager has the capability of doing this due diligence and analysis and can also invest for you. And this thus takes these tasks off your hands and enables you to continue experiencing all the benefits without putting in all the amount of time required. Another reason to choose an equity fund is the diversification benefit of investing in an equity fund, because usually a managed equity fund allows the ability for diversification, because the fund manager will invest in a number of different securities in a number of different sectors. This limits exposure to any particular company or any particular sector. And this might not be possible should you invest as an individual, owing to, again, capital constraints that might be that might be limiting for you as an investor on your end. And again, relieving investors from emotional reactions to investments, as we talked about the axiom of the market being ruled by fear and greed. And if there's a lot of volatility in stock prices, this can elicit a lot of emotional reaction to individual investors. And thus, in these investors who do not, they're still having these emotions of fear and greed, and they do not want to act on these emotions, then they can bring the investments to an equity fund where professional fund managers will invest on their behalf, who have more experience and knowledge of dealing in these swings and these volatile price swings. So they're able to better manage these volatility than could be an individual investor. And this thus cuts out the emotional reactions that investors might have to influence their investment decision-making processes via emotions. So those are some of the reasons for choosing an equity fund that can be a really good option for you as an investor who might be starting out or might not be as experienced in the equities market. So some of the features of an equity fund being, the objective is usually long-term capital appreciation. Risk profile is high because there is risk of losing part of your principal owing to the volatility in equity markets. In terms of asset allocation, you usually invest in equities listed on a securities exchange. The return is made up of capital appreciation and dividends earned from investing in companies that pay dividends. Time horizon is suitable for long-term investors, and the profile is for investors seeking long-term capital growth and also comfortable on taking on some degree of risk with a potential for capital loss. So choosing a good fund manager is key to support your investment decisions in the equities market if you do not want to take it alone, because again, a fund manager can employ all the strategies that we had discussed about. And Genghis Capital has the capacity to discuss and engage clients on all these opportunities discussed through investing in an equity fund. I now come to the end of the training and we'll take it back to Dora to take us through the next part of the webinar.
Thank you so much, Caleb, for the insightful presentation. So we'll now quickly jump to Q&As. So we have a question from an anonymous viewer, and he's asking, where do you get preferred stock? I see, Maurice, you answered it, but could you kindly do it live for the sake of the other attendees? Where do you get preferred stock? Maurice? Or could you have Caleb? Caleb, please answer that.
Come again, I didn't get the question.
Where do you get preferred stock?
Oh, preferred stock. Preferred stock are not as common. They're not as widely available as common stock. I think in our market we only have KPLC that has two types of preferred stock, that is the 4% and the 7% preferred stock. They're not also that popular in terms of from the companies who are issuing a stock in the first place, because usually preferred stock come with a number of conditions, like you have to pay a given percentage in terms of returns or in terms of dividends before going to pay a common shareholder. So they're not as common, they're not as available as common stock. And then most companies actually do not go for preferred stock, issuing preferred stock, because of the risks, the certain risks to the company of issuing preferred stock. One of them is before, like let's say even if it's a growing company, it issues preferred stock. Let's say it's a 4% preferred stock. For 5 years, it does not pay dividends, but the 6th year it wants to pay dividends to common shareholders. Sometimes there are conditions that the preferred stock has to be paid those 5 years of dividends and the 6th year of dividends before any funds can be available to common shareholders. So they're not as available, and most companies actually don't even issue them.
Okay, thank you, Caleb. Maurice, I believe you're here with us. So could you please answer this? What do we look for in earnings reports for us who have no business education?
So when company released their performance, let's say like, for example, now banks are releasing their annual performance for the year 2020. What you look at, number one, you look at the statement of the earnings generated from the cooperation of the company. For example, if it's a bank, from the cooperation of the bank, the main activity of a bank is lending and also carrying out investments. You look at the earnings coming from that. Then you look at the how can this earning persist into the long run. Then look at how will the prevailing macroeconomic environment affect the earnings capacity of this bank. And now when you look at all, it gives you an idea of the level at which the earnings for this company will always be coming at. Look at, if you get a company, let's say that is in a bank that have just sold an asset, selling assets is not the cooperation of the bank. So you will treat that one as just a one-off earnings. So you look at the consistency, earnings coming from the cooperation of that specific company, you take that earnings, place it in the economic environment, and now determine how will economic shocks affect the earnings of the bank. Then from there you come to have an idea about the consistency of the earnings from the specific company in question.
Thanks, Maurice.
So it is difficult to look at it if you don't have a business knowledge. It's difficult. You must. It's a must.
Okay, thank you, Maurice, for handling that. Felix Njero is asking, what is the best method to determine the intrinsic value of a company? Caleb, please.
Determine the intrinsic value of a company.
Yeah, what is the best method to determine the intrinsic value of a company?
Well, here you look at the fundamental, basically fundamental analysis of the company. You look at earnings, growth in assets, growth in revenue, all that. And usually when you look at the intrinsic valuation of the company, you'll have to do a model to forecast into the future and determine how much the cash flows will be worth, let's say 5 years into the future, how much they're worth today. So it involves a lot of modeling. There are a number of techniques that you can use, like a discounted cash flow technique, a dividend discount method technique, a free cash flow valuation technique. So there are a lot of valuation techniques that you can use to basically determine these cash flows in the future, what they are going to be worth today. So that's what the models usually do, and that's what a lot of investments, a lot of analysts spend most of their time doing.
Okay. So
Dora, can
yes.
add on what Caleb has said, what Caleb has given. If I can just add another, put on that a different angle.
Okay.
Basically, there's no best method for doing evaluation. It depends with the type of the company, the industry, the regulatory environment, and also the stage of the growth of the company. If a company has just started, it's not even paying dividend, it's not even a positive profitability, there's no way you can use discounted dividend model to look at that company. If the company is in a very restrictive environment where they can't even pay that dividend, given their capacity to pay, again, you'll have to look at a different way of looking at the company. So you have to look at the subject company, regulatory operating environment, the stage of the growth, and now determine which method will actually best give you the true value of that firm.
Okay, thank you so much for the additional information, Maurice. So Ernest and Cliff are asking if there is a platform for Genghis where you can trade in shares. Yes, we have an app, Jikuze, where you can download and then you're able to trade shares listed at the NSE. And then we have a question from an anonymous viewer. I just downloaded the app. What is East African Trader? Does that mean I have more options to trade outside Kenya? Maurice, please.
I think for now, the only option we have is to trade in the securities list and obviously securities exchange. But on the background, we are doing more development work to give our clients access to other East African exchanges.
If I could add on that, when you're onboarding on the app, you have to choose if you're a local investor or a foreign investor or an East African investor in order for us to determine your tax status. So when you're being asked to identify if you're an East African investor, it's just, are you a Kenyan, are you a foreigner, or are you in Uganda or Tanzania? So that's just one bit of information that's requested during onboarding.
Okay, thank you, Damaris. Would you consider Centum buy as a value investment? That is Beryl Onyango's question. Maurice, kindly tackle that.
I'm seeing Maurice smiling. Maurice, you're on mute, but maybe as you unmute, I can just say, I don't know if this is the perfect platform to actually discuss specific stocks, but we do have a webinar that's open to everyone. It's called the Genghis Weekly Investor Briefing. So it's every Monday between 9 and 10. You can get a link for registration on any of our social media platforms. And during that webinar, 1 hour every week, our research team gives very concrete trading recommendations. So they talk about the different stocks. They talk about what they're recommending for a buy, for a sell. And we also have a segment that includes the global financial markets. So I'll give it over to Maurice to talk about Centum. But if you really want to now discuss the nitty-gritties of the different counters, then please join us every Monday.
Thank you, Damaris. If you look at Centum, first of all, before we go to Centum, now we look at a value company. It's a company that is trading at a multiple that are at discount compared to the one the industry in which it's operating. If the company is the only company, listed company in that industry, then you look at the company vis-a-vis its books. So if you look at Centum books and you calculate what is called NAV per share, then you move net asset value per share, then you move with net asset value per share, and you compare with the prevailing share price for Centum. If it is above, if the share price is below the net asset value per share, then it's a value stock, which now means just looking at the book, if they just keep whatever they have, there's a potential upside that you can get. I'm sure if you look at Centum now, the share price and the NAV is a discount. So at that point, you would consider Centum as a value stock for now. But also the other challenge, we're going back to Centum net asset value per share simply because there are no companies that are similar to Centum that are listed in the market that would compute, let's say, weighted multiple for the sector and compare with the multiple for Centum.
Okay. So Maurice, could you kindly tackle this question? How do you find out the average dividend payout of the market so as to make comparisons?
There's a more work, a lot of work involved. You'll have to have a list of all the more than 60 listed companies. And the next item you'll have to get for all these companies, their earnings per share, How you get earnings per share? You take the total profit after tax of the company divided by the number of authorized and issued shares, and you'll get earnings per share. Then the next thing, you go and get the dividend per share. Dividend per share, we then have the portion that will be paid out to shareholders divided by the number of shares to give you dividend per share, what we call DPS. So you already have earnings per share. You will have a dividend per share. Then now, if you take dividend per share over earnings per share, will give you the dividend payout per company. Then if you get average, you'll have already got an average dividend payout ratio for the listed companies.
Okay. So Rehab Mbogo is asking, you mentioned that there are platforms that have analyzed the stock prices. Kindly list the platforms.
Well, in terms of analyzing the stock prices, there are a number of, I would say, analysis platforms, analysis websites. We have Bloomberg, we have Reuters, that give you more data and previous focus on the previous data on individual stocks and companies. So in terms of analysis, not in terms of individual stocks. They don't do analysis in terms of individual stocks. What they do is they can give you an average of what traders, of what researchers expect the share price to be. Like, let's say they can give you, let's say it's one company like Safaricom, maybe has 10 analysts covering it. 5 analysts are saying buy, 3 analysts are saying hold, 2 analysts are saying sell. So they give you that breakdown for you to also look at it. Alternatively, you can also go to the individual research houses. You can come right here in Genghis, that we also do a weekly webinar that, as Damaris has pointed out, that gives you more detailed analysis on individual stocks.
Okay, Caleb, maybe you could quickly answer Bernard Onsongo. He's asking, what is private equity?
Private equity is basically investments in private companies. What happens is a lot of investors are looking at private equity as a new asset class. It's basically equities that is not listed, and you're trying to grow it still within the private markets. So it's long term. It has most of the characteristics of equities, except that it's not as liquid because it's still in private markets. Still, the return can still be achieved by price appreciation and dividend return if the private company is paying dividend. So just almost like equity investment, the same ownership, but now it's just in a private company that's not yet listed.
Okay, Maurice, I remember you mentioned how people can be able to interpret results of a company in order to understand if to invest or not. But if you could quickly answer Nyanj, how would you know how to read a monthly or yearly graph of stocks? What to look out for so that you know if it's a good one to trade?
Sorry, how would you read what?
How would you know how to read a monthly or yearly graph of stocks? What to look out for so that you know if it's a good one to trade?
Sorry, I'm not getting the question.
How do you read, if there is a graph of maybe the way the stocks are moving, how do you interpret those graphs? What do you look out for when they share the graphs or something so that you decide if the stock is good? Yeah. Okay,
number one, you look at how the company is performing in terms of, let's say, if you're looking at a company that's given, let's say, banking sector, look at how this company is performing with what you'd call the peers. Perfect comparison for that company. Then if the company is lagging, yet you believe is supposed to be at par with the peers, then there's already a discount that you stand to benefit. Then number two, you look at how the company is trading vis-a-vis the overall stock market and compute what we call correlation between the share price movement for that company vis-a-vis the market. Then now you look at if market is going up, then you just know there's high chances that this stock is likely to go up. A very good example, people say KCB. Look at KCB and Equity Bank, they almost move in the same direction. If KCB starts, just know Equity Bank will follow. If KCB starts going down, just know very soon is coming Equity Bank also to start recording price decline. So then there are also things, I think also what there's a question to do with that in the Q&A tab, where you look at things that we call even technical analysis, look at momentum indicators, resistance level, just to give you an idea that this company is either overbought or oversold, then you take the appropriate decision. So I don't think I can even exhaust the number of curves and graphs that you're supposed to look at, but basically that's how you're supposed to look at some of them that I've highlighted.
Okay, thanks, Maurice.
There's another.
Okay. Bernard Onsongo is asking if one can buy 90% of shares in a company.
In a company listed?
Yeah, can one buy 90% of shares in a company? Bernard Onsongo.
If it's listed, then more often than not, the regulator will require you to take it private, because that is more than the threshold that is deemed being publicly available. If you're more than a 90% owner, I think the threshold is around 75, but anything above 75 is a candidate for being taken private. At that level, you can just mandatorily buy out the other public investors, holders of the stock, and take the company private.
Okay, so there is another question on cryptocurrency. What are the challenges of investing in cryptocurrency in Kenya? I just read an article of founder of Kipochi closed the company in Kenya in your app. Why did it happen? I'm sorry you didn't leave your name, but we have, like Damaris earlier mentioned, we have like a weekly webinar every Monday, 9 to 9:30, where we tackle cryptocurrency and other generally news on the local and global financial market. So I believe that will be best handled. So kindly join us on Monday at 9 for more information. So Kayla, do you have sorry?
Dora, this is Damaris. Let me just jump in and help you with a couple of questions, because I'm very happy to see that we are having a very rich discussion. I think some of these questions we've dealt with previously. So Wamboy is asking whether Genghis does Forex trading. So Genghis doesn't do Forex trading, but we have a platform that allows our clients to engage in FX trading along with other global financial market options. So if you're interested in either trading in foreign stocks or stocks outside of Kenya or Forex trading, we kindly request you send an email to marketing@genghis-capital.com. I've typed the email on our chat function, and then we can help you by ensuring you get the necessary information to get you started. So I hope that helps. We have someone who's asked, or rather Bernard Onsongo, who asked, I'm interested in buying shares of private companies not trading on the NSE. Can Genghis give us a platform to do so? So Bernard, it's not that we can give you a platform, but we have a corporate finance department that deals with people who are interested in investing in specific companies. So for example, if there's a company that is new, establishing itself, and they are capital raising, but they're not listing on the NSE, they usually work with our corporate finance department. So again, if this is something you would like to continue, I urge you to send an email to marketing@genghis-capital.com, and we'll make sure that we link you up with our corporate finance team. So Hilary Wamboy is asking, how can one set dividends to be deposited into your Jekuze brokerage account instead of bank account? Now, Hilary, I think this goes back to Caleb's presentation where he talked about when you buy stock, you're in essence buying ownership of that particular company. So what Genghis does is gives you a platform in order to do that, right? But when you're being paid out your dividends, you're being paid out as a shareholder. It doesn't have to do anything with your CDS account. And that's why it goes directly to your bank account if you've selected bank deposits. I know there's also an option of issuing out checks, although I think that's been phased out due to the current situation. So there isn't a way for your dividends to be sent to your brokerage account, but I stand to be corrected by my team members. Wamboy, the question about stocks from around the world, I believe we've addressed. Dora, I'd like to hand back to you. Dora, you're on mute.
Sorry about that. Can someone get a one-on-one training on the app or trading online? Where and when? Any charges for training? Jane Wenja, if you need like training on the use of the app, we can send like a detailed user guide for the app, but you can still DM us your number so that we can reach out to you. Kindly reach out to us, then we'll be able to give you the information that you need on how to use the app or trading. So we have Brian Morezi. Once you've earned profit from shares, do you have to file returns with KRA? Maurice, kindly answer that.
So if you are paid dividend by the subject company, then dividends are subject to a 5% withholding tax, which is final. If you buy and sell shares, I think the loan capital gain was suspended, tax was suspended some time back. So capital gains, you carry everything. Dividend, you will pay 5% withholding tax, which is final.
Okay, thanks, Maurice. I'm just trying to have a look and see if we have any questions pending. There is a viewer who's concerned, does Genghis Capital invest in its own money or the customers? How do you make money? What's the net for you? Kenya, there is a lot of schemery and shrewd people. Since you're a new company, how do we protect ourselves from such things as chase bank scenarios? We'd like to let you know that Genghis Capital is regulated by the CMA, but I'll let Maurice touch more on that to reassure you.
We, as an licensed fund manager, we manage third-party monies, and also we can also manage our own funds if to run our own proprietary book. But how we manage third-party monies, especially through a unit trust structure, there are different parties that are involved. The regulatory framework to ensure that at least the funds are safe. Number one is the enhanced role of the trustee to ensure that at least investment are done to meet the underlying investor, the ultimate beneficial investor's objective, and also regular reporting to Capital Markets Authority, and the assets are held under custody account, which all these framework are just put together to ensure safety for the investors' fund, and also the frequent reporting is done on a quarterly basis to Capital Markets Authority to also ensure that at least they know where the funds are invested. And I think reporting has become more detailed nowadays. You even learn about specific stocks, specific banks that you place deposits with, banks that you stocks that you bought, so that the regulator is in the know and everything that you are doing.
Okay. So Rehab Mbogo is asking, insider trading, what is the current situation of this in Kenya? Sometimes you hear that people sell off their stock and they benefit more than others. Maurice? Insider
trading in Kenya, not even in Kenya, insider trading is illegal. So if you trade based on information that is material and non-public, just know now you are getting into another zone that you find yourself into problems. So trading based on insider information is illegal. And if you do that, you will find yourself in the problem. You can even be taken to court. And here we have different cases that we're even aware of that has people landed in court just because they traded on the insider information and they benefited.
Okay. Caleb, kindly answer Brian Morezi. He's asking, is it easy to find a new investor to buy out your shares? Caleb?
Come again? Is it easy?
Brian is asking, is it easy to find a new investor to buy out your shares?
Yes, the equities market is quite liquid, so you're able to easily invest and sell off your shares. Again, some companies are more liquid than others. Like the most liquid company on our stock exchange is Safaricom. and we have some that are not as liquid, so it might be a bit more challenging. But generally speaking, stocks are liquid, so you should get a buyer and a seller. The issue might be at the price that you possibly want to sell at 50, but maybe the market price is at 40. Then now you can't say that that there's no one to buy your shares. But if you want to then sell at the market price, then you should be able to get shares. Though try and again try and follow the companies that are more traded, that actually trade every day. There's some companies that are listed, yes, but they're not as actively traded.
Okay, so there is a question from Annette. He's requested we repeat the email for the Forex trading and inquiries. Annette, the email is marketing@genghis-capital.com. And then he's also asking if you have like equity funds on the app. Currently, we do not have an equity fund on Jikoze app. What we have on offer is our money market fund, and currently has a rate of 10.13. How do you protect the client's money?
Come again?
With the current economic status, how do you protect and maximize the client's investment?
What's the question? In the current?
With the current economic status, how do you protect and maximize the client's investment?
Number one, you limit investing to sectors that you know have potential. Economic shocks are part and parcel of any investment process. There are going to be ups and downs. And at the end of it, a person who has, let's say, for a person who has invested in it must first, number one, have a long-term investment horizon. Because in the long run, you've seen equity markets usually rewards investors. So to protect your interest, number one, look at companies that are fundamentally strong and take position in that. Look at companies that are in sectors that are stand to benefit in case there's economic, in case economic start performing better. Then you skew your investment towards that. And Caleb highlighted, equity investment is not a place like for money market where you get in and get out wherever you want. Whenever you get in, be prepared to be there for a long run. A good example that I usually give people, if you look at the time 2008 when Safaricom did an IPO, it was at 5 shillings per share. 2011, the share price was trading at 1 shillings and 95 cents. If you look at currently now, Safaricom is almost pushing towards 40 shillings per share. No share consolidation has been done. It's the same share that was trading at 1.95 cents in 2011 that is now trading at almost 40 shillings in 2021. If you look at 2011, 2021, that's a span of 10 years. The person who actually had a long-term investment horizon has seen his or her share price move from 1.95 cents to 40 bob. So if you can withstand that time, the market is yours. If you can't, go and play in money market and bond fund and those.
Okay, thank you, Maurice. Kindly.
Okay. Hey, Dora, I'd like to just jump in and help with a couple of more questions as we come to the end. We can always continue this conversation on our social media handles. We are on Twitter, Instagram, Facebook, and LinkedIn. We also have a Telegram channel. So once we come to the end of this, if you have additional questions, just find us on social media or drop us an email. I've seen an email from Joel Msafari. He says he asked an earlier question on the tools he could use to simplify the analysis for stocks. So Caleb or Maurice, could you kindly answer that? Then we'll take 2 more questions and wrap up.
Okay. Tools can simplify analysis for stocks. As I said, the number of indicators that you can look at. If you're using just, it depends on which strategy you're using. If you're using a fundamental approach, then you still have to do in the work and the time and try and model and forecast and try and get the intrinsic value. If you look at it from possibly a technical perspective, the other indicators that you can use, you can look at moving averages, you can look at the relative strength index, the RSI, if it's out from the oversold area, then you can start buying. If it's in the overbought area, you can start selling. But basically, in terms of simplifying it, it becomes much easier when you either enroll or get information from research houses, or even just come to an equity managed fund.
Awesome. Thank you so much for that, Caleb. So I'm seeing questions about guys who are asking how to identify Ponzi schemes, the minimum amount they can invest in, how they know the right kind of stocks to invest in. I think ultimately, one, it comes to the advice that Caleb gave us. The stocks you invest in are based on your risk appetite and also the interest you have in a specific sector. We'll be resharing the presentation that Caleb gave us, and hopefully that will help us avoid these pitfalls. Regarding the minimum amount you would advise someone to invest, Caleb, if I'm not wrong, the minimum to invest on the NSE is 100 lot of shares. So the minimum amount would be based on the value of a particular stock. So the minimum amount to buy 100 shares of Safaricom is going to be different than the 100 shares of EABL, Centum, etc. And you also have to know what's your investment strategy as you're buying this 100 shares. If you're buying this 100 shares to earn dividends, then you need to look at the dividends this company has been issuing. If the dividends is 50 cents and you've bought 100 shares, you can do the math and perhaps consider maybe investing in equities is not something you can do right now. And that's where the alternatives like equity funds, where your money can actually be doing a lot more for you than it would, like, for example, on the stock exchange with the amount of money you have to invest. I think in the same breath, I can address Ernest Kibuthu's question. He's asking, so is it safe to say that I can use the app to deposit my savings to earn interest? Yes, Ernest. That's the premise of the money market fund. You put money in the account and it earns daily compounding interest. So if equities is not something that you're ready to get into, there are alternatives in the market. So I think we can safely come to the end of this session. Caleb, any final words? And then Maurice, and then we can conclude.
Thank you, Boris. For me, just a quick recap on the training is try and do your analysis, following your own analysis. And if you still want to invest, you can come to a managed equity fund where the investment decisions are being made for you. And that might limit some of the pitfalls that come when the pitfalls and investor mistakes that might come if you're doing it solo.
Thank you so much, Caleb. Maurice?
For me, is at the end of the day, ask yourself when you're investing, what exactly you want to arrive at. At the end of it, you want a return. So ask yourself, would I get a return? I have let's say I have 10,000 shillings I want to invest. Would I get a return to go and buy shares myself in an exchange, which I'll only be able to invest in one single company, or I'll take my 10,000 and invest in what Caleb is referred to as managed equity fund that will give me a diversity into a different array of stocks, so that now through 10,000, I will have exposure in Safaricom, I'll have exposure in banks, I'll have exposure in FMCG, I'll have exposure in different sectors that gives me diversification. So at the end of it, look at what exactly do you want to get. It's not necessarily going to buy shares in an exchange. You can still get the same return, but by investing by a more diversified arrangement that will give you more safety and more benefit of diversification compared to you working yourself to go and invest in an exchange that will give you again more difficult work to do, following, tracking, knowing when to sell, knowing when companies are releasing results, going look, checking whether the results are good or bad, things like that. So the best avenue would be pursue it through a managed equity fund, so that you stand to get benefits of diversification also from pooled fund with other investors.
Thank you so much, Morris. Dora, I hand over the session back to you.
So thank you, everyone. We're glad that you joined us. As earlier mentioned, the video will be uploaded to the Genghis YouTube channel. We'll also share an email with the link and the presentation as well. And we hope to see you on Monday for our weekly investor briefing. So thanks, everyone. Have a lovely afternoon.
Thank you.